Household finances are being squeezed right now. This is a big topic everywhere, like it is here in the UK, where this combination of inflation, tax rises, higher interest rates, and low wage growth are creating this perfect storm. This is being dubbed a cost of living crisis, a social emergency that threatens to push millions of people into poverty. Now, the basics of this crisis are that household expenses are increasing, but incomes for the majority of people simply aren't keeping up at the same pace. So this means that real incomes, which is income adjusted for inflation, are actually falling. And we only have to look at the latest wage data in the UK to see that real average earnings fell 1.3%. Now, on the surface, you might think the solution is simple. Cut back on expenses, stop buying luxuries, and stop buying those Starbucks coffees, at least according to so-called personal finance experts. But while all of that advice may work for some people, excluding not buying coffee, for many others, there is no more room to cut back. So this leaves us with a very real threat that many people will be falling into poverty. So in this video, let's take a look at some of the causes and potential effects on the broader economy, which affects everyone in the economy. If we look at the latest CPI data for March, inflation hit a 30-year high of 7% in the UK. But it's not just the UK where inflation's running high, it's a similar situation across most of the whole world right now. And there are many reasons that can be attributed to this, from global disruptions such as the pandemic, supply chain problems, and most recently, the war in Ukraine. Then there's also regional issues specific to each country that can compound these problems. For example, in the UK, these include the aftermath of leaving the EU and tax hikes. Now, the first major cause is one that we're obviously all very familiar with by now, which is the pandemic. Ever since economies began reopening, inflation has been accelerating. And we can't really talk about inflation without also talking about energy prices. They hit rock bottom back in 2020, but as economies reopened, demand picked up pretty quickly, but supply was only gradually increasing. So as the supply and demand model would suggest, this caused energy prices to continue pushing higher, well above pre-pandemic levels. Now, throughout last year and the very early part of this year, most major central banks were adamant that inflation was transitory. This now infamous word that seemingly meant different things to different people and something entirely different to the central bankers themselves. But the thinking was that as supply and demand began to balance out more, prices should become more under control, and therefore inflation would stop accelerating and move towards the bank's target rate rather than having persistent inflationary effects. That didn't really happen though, and for the UK, that meant that major problems started to develop in the energy sector. You see, in the UK, energy suppliers that buy from producers and sell to households are regulated by Ofgem. This is intended to stop things happening like price gouging. Now, Ofgem imposes a price cap on what energy suppliers can charge to consumers. And this is great for consumers, but it does limit what energy suppliers can do in situations like we've been seeing where wholesale prices are skyrocketing. Within the past year alone, 29 UK energy companies, which represents around 4.3 million people, or 6.5% of the population, those companies have gone bankrupt because consumers are paying less for gas than wholesale prices. So to address this, as you'd expect, the price caps are increasing. Now, before April, this price cap was set at £1,277 per year for around a third of the UK population, but that increased to just under £2,000 on April Fool's Day, but it wasn't a joke. And in fact, a further kick in the proverbials is coming later in the year when it will rise once again to an estimated £2,600 in October. So that's a 100% increase in less than a year. The Bank of England has already said that this will cause inflation to rise in April, and even if it slows down over the summer, it may jump again in October when the price cap increases once again. And remember, inflation already hit 7% in March, so now forecasters are expecting that it could push above 8% in April because of these energy prices. But that's not all, because more pressure was added to household finances on the exact same day as the first energy price cap increase, because the VAT rate returned to 20%. VAT is value added tax, so if you're not from the UK, this is basically our sales tax. There are still debates about whether VAT is more or less regressive than other alternative tax changes. We won't get into that debate for now. All we can say is that it's going to add pressure to households since they're going to be paying more tax on goods and services that they have to buy. And then there are other hikes that are happening as well, like an increase in national insurance contributions, which alongside the rising prices of food is making some households really feel the strain. But what will all of this mean for the economy? Consumers are going to have less money to spend, and with increased borrowing costs right now, it seems difficult to see how the UK economy will maintain the growth we've been seeing, which already hasn't been that great in the first place. The latest GDP data showed the economy only grew at 0.1% in February, which has led to fears that the economy could end up in stagflation. Now, the situation's being compared to the late 1970s and early 80s, where higher energy prices, primarily oil, led to a downturn in the UK economy, while also experiencing double-digit inflation. Now, since inflation was running so high, peaking at 22%, the Bank of England tightened monetary policy to try and control it, and this resulted in a sharp decline in the economy, and unemployment rose to a high of 12.5%. The economy went into stagflation. If you're not sure what stagflation is, check out our video up here that explains it. Now, at the moment, forecasts don't point to such a severe recession as that. Inflation isn't expected to hit double digits, and employment is still very low following the post-pandemic recovery. But since the invasion of Ukraine began, this created a lot more uncertainty, and high commodity and food prices are likely to last way longer now than what was previously expected. But as long as they do stabilise, headline inflation should begin to slow down a little bit. As for the UK economy, the Bank of England really has its work cut out now. There's no guarantee that inflation can be slowed, especially without throwing the economy into a recession. One of the latest buzzwords that we've been hearing from central banks at the moment is that they believe they can avoid a hard landing. Jerome Powell from the US Federal Reserve in particular likes that one. So just in case you're not sure what that means, a hard landing is a rapid decline in economic growth, similar to what I described happened in the late 70s. So what they're trying to achieve instead is a soft landing, where they can tighten policy enough, like raising interest rates and stuff, while the economy can remain relatively stable. Now, a soft landing doesn't mean the economy won't slow down or even tip into a recession, but it's done so at a so-called acceptable level where unemployment doesn't shoot too much higher and it can easily be corrected without having to flip policy too much, like by having to rapidly lower rates again. The problem is though, monetary policy is very good for influencing demand, as we saw during the pandemic, but it's not so well suited for supply side problems, particularly external supply side problems originating from outside the country, like gas and oil. So we can think of inflation as being like this seesaw. On one side we have the supply, and on the other side we have demand. And one way to reduce prices is to increase supply, another is to reduce demand. And by doing both at the same time, well, that would be the best way to reduce prices. So if we see that most of the problems are on the supply side, it's very difficult for central banks to completely solve the problem. They can alleviate the problem somewhat by, doing as much as they can on the demand side, but it doesn't fix the supply problems. It can support the overall situation to a certain extent, but not completely solve it. So that means raising rates may only have a limited effect on slowing inflation, but it may at the same time slow down the economy and risk throwing it into stagflation. So it's definitely not an easy situation to deal with, and there's no simple solution. But while analysts, economists and central bankers can debate about what's needed and what's to blame for this situation, they're very fortunate to be removed from the vital debates happening right now in people's living rooms about which essentials they're going to have to try to get by without. As always, it's easy to see an economic problem as just a set of data, but the human side is what really matters.